All right. Firstly, my name's Nick Hill. I'm a consultant with insurance PR firm Prince Communications, and we've got three great speakers here today, and are going to cover the findings from a survey that was sent out to APCIA members and supplemented by some questions that were asked of NAMIC conference attendees. And then we're going to hear the story of how mutual insurer Innovated Holdings came to purchase an aggregate working layer reinsurance solution for severe convective storm losses. A couple of little bits of housekeeping. As you've probably noticed, the audio and video is off for all the attendees, but there is a Q&A function at the bottom where you can submit any questions, and we'll endeavour to get to those at the end of the webinar. So I just want to introduce the speakers. Jake Black is the CEO of Innovated Holdings. He's a growth-orientated executive with more than 25 years of success spanning financial services, insurance, education, and non-profits. He's held leadership positions in several organizations and was also the vice president and partner at Robbins & Black, a multi-million-dollar insurance brokerage in the Midwest. Since becoming president and CEO of Innovated Holdings, he's overseen an increase in profits, 7 mergers, an acquisition, and is continually working to take the organization to the next level. Welcome, Jake.
Thank you.
Our next panelist is Jim Botsis. He's the executive vice president and head of AcrisureRe's Chicago office and is a member of their North American executive committee. Jim's responsible for expanding AcrisureRe's operations in the Midwest. He's also focused on exploring synergies within Acrisure to increase organic growth. He's over 25 years experience in the industry and is recognized as an important advocate for the reinsurance industry too. So welcome to you too, Jim.
Thank you, Nick. Thanks for having me.
And our third panelist is Matt Coleman. He's the Chief Risk Officer for Reinsurance MGA Demex. He's got over 20 years of experience in building risk transfer businesses within the reinsurance and weather derivatives markets. He began his career at Citadel and spent over 11 years at Nephila, developing and scaling its climate investment business. He leads Demex's structuring and pricing of weather risk transfer transactions, including reinsurance for severe convective storms. There's going to be 2 parts to the webinar. Essentially, Matt's going to talk through the survey findings, and then we'll get into the case study. So I just want to give you a little bit of background and the methodology for the survey, just to set the scene. It was a blind survey that was sent out to APCIA members with no mention of Demex's involvement or any other company's involvement. We received 83 responses, of whom 20% of them were C-level executives, and 42% were mutual insurance companies and 52 stock companies. 60% of the respondents had more than 25% of their book being personal homeowner business. We don't have data of exactly where everyone's based, but because APCIA is obviously a national organization, we assume a pretty reasonable spread across the country. We've supplemented the information with some questions that we asked of NAMIC attendees in a post-conference evaluation. Around about 250 people responded, and we asked them questions around their biggest perils, risk transfer mechanisms, and how effective they felt they were for severe convective storms. So that's the background. I'm going to hand you over to Matt, who is going to talk through the key findings. Matt.
Thanks very much, Nick. Pleasure to be here today. And yeah, let's hop right in. The first question that we asked respondents was, which perils do they care about the most? And from the list of natural perils, it was clear that the ranked order and distribution put severe convective storms at the top of the list. So relative to these other perils, both primary and secondary, we see that severe convective storms are absolutely top of mind. Next. And then next, we wanted to get a sense of, with severe convective storms in particular, what is the impact of those types of events on loss ratios? And we see that nearly 60% of respondents said that SCS claims have a moderate to significant impact on loss ratios, equating to 100 to 300 basis points or more. And similarly, only about 20% considered the loss ratio impact of SCS claims to be minimal or less than 100 basis points. So clearly, these types of events, we're understanding now why they are top of mind. They are truly impacting loss ratios for many carriers. And next, we wanted to understand, how do carriers protect themselves against these types of events, particularly severe convective storms? What types of risk transfer products have they executed in the past and continue to use? And roughly 70% said that they do indeed protect themselves, and they typically do that with traditional reinsurance. Around the margins, we see that some other risk transfer techniques like parametric reinsurance, alternative risk transfer, other structured products are used, but by and large, traditional reinsurance has been the approach. We next wanted to get a sense of, looking forward into the future, how concerned are carriers about the financial impact relating to severe convective storm losses over the next few years. And we see that nearly 90% of respondents are somewhat or significantly concerned. And so what we're seeing is what the peril of concern is, and how not just today, but going into the future, it's expected to remain a concern. And our final question was, would you buy aggregate loss coverage for working layer risks if those products were available to you at an affordable cost? And almost 2/3, between 60-65%, said that they would purchase such coverage. And nearly half said that they would, or they may investigate further. And interestingly, the other third said that they probably would not buy that protection. So as we take a step back and think about what these survey results tell us, it's clear that there's some sort of disconnect that's going on in the market. Clearly, severe convective storms are of concern, and those concerns, those risks are being addressed with usually traditional reinsurance products. But at the same time, on a go-forward basis, this peril continues to be a concern. And then you add, different market reports and findings like AM Best reporting that 12 personal lines carriers experienced downgrades primarily due to secondary perils and higher reinsurance costs. And when you piece all this together, it shows that more research is needed, and that there is opportunity for innovation and problem solving around this specific peril of severe convective storms, and risk transfer solutions that can be useful in the market.
Great, thanks, Matt. Jim, I just wonder if you've got any comments on the survey, and maybe more broadly in terms of what you're seeing in the marketplace at the moment.
Yeah, no, Nick, thanks for that question. What we've been seeing in terms of carriers is big concern with regards to what's happening in the severe convection storm space. Obviously, insurance companies, they can go out and buy a traditional property catastrophe tower to protect them against the severity of an individual loss. But the concern has always been what happens to all the net losses that a company can take on from a net basis, where it may be eroding their surplus. When the market was softer, we would go out and we would place property aggregate type covers, to help pick up some of those net losses that fall under the traditional property cat tower. But what we saw in the 2000s is really that market space dry up. All right. And we had a lot of companies come and say, we have a concern in this space. Our retentions from the property cat standpoint have increased twofold when the market was harder. They saw attachment points of the property cat program, attaching at a 5-year or a 10-year return period. And what I mean by that is where their first layer would attach. And that was a lot of net loss that a lot of these carriers, had to take on. And so the question that we had is, are there alternative methods out there that you can bring to the table? And that was one thing that Demex had really stepped up in the marketplace to provide an alternative with their product out there.
Great. Okay. Thanks, Jim. Just want to remind people watching this that if they want to submit some Q&As, there's the Q&A tab at the bottom of the screen. So feel free to put some questions through, and we'll see whether we get to them. So that was the survey findings. Really sort of interested in the disconnect and whether people feel there is a disconnect between how their risk transfer programs are set up and the actual impact of severe convective storms on their losses. We do also have Jake Black here, the CEO of Innovated Holdings, and really interested in hearing Jake's story on how they've worked through their risk transfer solutions for particularly severe convective storms. So I'm going to ask Jim just to give a brief intro into how everything was sort of set up, and then Jake to walk you through the journey.
Yeah, no, thank you for that. Jake and our team over at AcrisureRe have had a tremendously long relationship. We've been placing his reinsurance program for a number of years. As I alluded to earlier, when the aggregate market space dried up and got hard, Jake and his firm, they were looking for alternative options out there to the traditional aggregate marketplace. Okay. And one thing that we had discussed with Jake is that a new product from Demex was entering the market. It was on a parametric basis. These folks were attending NAMIC and a handful of other events that we felt that it was important for him to sit down and understand, what is a parametrics cover? How does that differ in terms of indemnity losses versus model losses? So a few years ago at NAMIC, we brought the groups together to meet and to understand and explain the product to see if this could be a fit for Jake. And, at the time, it was something of interest, and we explored the cover. The data that Demex needed was very minimal that we already had in terms of a reinsurance submission, in terms of quoting and tracking to see if this was a product that could be a fit. And kind of the rest is history from that standpoint. So I'll turn it over to Jake to explain how they look at transfer of risk, particularly on the severe convection storm, and look at it from a company perspective.
Thanks, Jim. Good to see everybody. A lot of familiar names here on the sign up, so I'm sure my story is going to resonate very clearly with you as far as similar challenges that everyone's been through. For those that don't know me, my name is Jake Black. I'm CEO of Innovated Holdings. Innovated Holdings is a group that we developed in 2018, really to bring some power of buying an alliance to mutuals, specifically in the Midwest, while still maintaining their identity and control in the boardroom, which is very important to me at heart from a mutual philosophy. With that, we have a super exciting new venture that will be coming out here soon that will allow us to continue to ignite some progress within those mutuals, but preserve the tradition on a broader scale, which we're excited about. But part of that challenge with really viability of mutuals in the Midwest particularly is the same story that everyone saw 2021 through present, right? Just continuous storms that just beat us up left and right. Reinsurance market that I think hard is a very nice term if you went through that, right? We definitely redefined the term of relationship through that with a lot of long-standing ones. And so it put us in a spot to where a company that statutorily had to have an unlimited aggregate that now has been changed by statute, what other options are out there besides ceding off a tremendous amount of revenue to support a maybe coverage that you hit or won't hit, but definitely not one that's sustainable for reinsurers to just continue to pay like a slot machine and trading dollars back and forth between company and client. It's really important from our flag CFM, which is, 156 years old. Through those years, you just kind of have to figure some things out, right? And this year it was in this period was reinsurance. Reinsurance is very important to us. It's one of our biggest spends, but it's also one that we look at an ROI on a 3-year roll and make sure we have a really realistic return or lack of tapping into that with a lowering rate. So Jim had brought this to me several times with the parametrics product. It's something that many of you are familiar with. Across the pond is used in a lot of the bigger companies here in the United States, but relatively new to our market. We went through that view specifically to wind and hail and severe convective storm that just never stopped. As far as the main impact of our balance sheet was just the sucking dry of those retentions and premiums that we were paying out. I think what attracted me to the Demex side was the reality that you take your book with the product that we purchased at a current point in time, and you spend a lot of time on the modeling to make sure it's realistic to your view and business planning down the road, and then the cost is established to it. So when that storm comes through, it's not an indemnity look of how much am I paying out to get recovery. It's how much does the model show that I had loss, right? So to me, it was a much more consistent view on that side. And we were able to use it just like an aggregate. That's what I purchased it for, was to replace that mindset of here's my attachment point, everything over the attachment point, it's just like an ag recovery. That was my mindset. I think becoming more and more familiar with the product, I think you could put that in your reinsurance stack a million different ways, even from a cat type of product to an ag type of product, and just become, if you will, the sprinkles on top of the cupcake of what you're doing with the beef of your reinsurance program. Or you could take the opposite look and say, maybe this is the meat of my reinsurance program, and I'm going to go off the more consistency of modeling and put some more traditional ones on top of this, from a quota share or cat layer to make me more comfortable. So going into it eyes wide open from an ag, I think now, again, I'll reiterate that I think you could fit this in a million different ways, as long as you did it in a way that was respective to your program and likelihood of loss. So this year, as we fast forward, we made huge changes into our book, as many of you probably did, from deductibles to rates to underwriting requirements. We deleveraged some risk, but we saw severity and frequency of the storms continue, right? 2025 was no different with that year to date. Now, I hope, as many of you do, I hope that's done and we're finished and we can all start thinking about wrapping presents for Christmas, but I think there's likely awareness on the horizon that we want to pay attention to. But for us, it has been very fruitful this year, and it's been one that has had a nice return on a consistent model in the time that's been in. And one that we absolutely will stick with and introduce to several of our other mutuals within our alliance and group that they can benefit from, no matter what the size of that company is, whether you're a $150 million, $250, $300 million, or you're a $10 million company. I think this is a great product that can fit into your stack and really kind of give you that sleep at night factor, if you will, that many of the CEOs and reinsurance buyers really long for. So if the wind blows, you have something that has a backstop for you as we go.
Cool. All right. Thanks, Jake. I have an extra sort of question for you in terms of, because everyone's always very comfortable with the traditional indemnity products. How easy or sort of, whether it's a bit of the process, was it to sell the more non-traditional approach of this to your executives?
Yeah, great question. Great question. I think, like any other product, you're not familiar with it. You've got to get your head around it and understand the likelihood of return and what triggers what and what the model looks like. I think through the process for us, because I will be very transparent, say we spent a lot of time on this. The AcrisureRe team, thank you for holding our hand in the process to understand that, and the Demex team as well. But we became even more familiar with our own book of business through the modeling process of really understanding what you had in totality, because the model was much more unique than the traditional reinsurance market in the way that this was set up with Demex, which was fruitful to us. And again, I think proof of concept, right? So year one, we started to see that hold true as the months ticked out in Q1 and Q2, to see what was a realistic view for our company as far as bleeding considerably in the spring and summer when the storms come roll through. So as we modeled that, we did very much a roundtable view of that with underwriting and claims and the senior executive team to really dig in and understand and ask questions. And that's not normal with our normal reinsurance buy. And it was exactly what you said, Nick, to get them to a point of comfort and understanding on how this works, and understand our book a little bit more, which we achieved all those.
Okay, great. And you kind of meant, so you've had a payout, we've already had a payout from the solution already. Did that help cement or change any of the executives' kind of mind, or reinforce your conversations? Did that make sort of a difference in knowing that the product actually does what it says it should?
Yeah, I think it taught us really two cool lessons, from our view is, specific to the Missouri book is, the biggest skeptic was definitely our CFO from a bean counting chair of how is this investment in the likelihood of some type of recovery or second year, third year recovery for the investment going to show the ROI, and just the probability thereof, which she spent a lot of time analyzing. And now has shown a small return, right? Which is good. That's what it's there for. And the reinsurance partners that we have with it on the back end, get it completely on that side. I think the other side that really helped in this year is the analysis from our chief underwriting officer and our VP of claims to see, how their boots on the ground type of approach with underwriting guidelines and changes and adjustments to our book for a healthier perspective, really held true in year one, right? So as a statutory protected mutual, we can pivot a little bit quicker than some of the other guys can as far as rates and forms, which benefits our policyholders completely. But I think for the claims guys to see what they're settling claims for versus what the model says we should, showed that those underwriting levers were working, which reinforced the underwriting chairs as we went. So, if you will, it's a perfect storm, literally and figuratively, for our whole team to see this is a great new concept, and I'm glad we hopped in when we did.
Cool. Well, thanks very much for that, Jake. If anyone's got any more specific questions about the case study, then please fire them into the Q&A. One of the things that comes up all the time, particularly in relation to parametric products, is the concepts of basis risk. And Matt, I just wanted to kind of ask you a little bit about how closely the Demex solution tracks actual claims experience, and just to kind of talk through I guess the basis risk of the Demex solution.
Yeah, thanks for that, Nick, and thanks for that case study overview, Jake. I think Jake really captured what's been so exciting in the eyes of Demex and servicing these transactions and helping to reopen this market for aggregate risk transfer. The idea of a cedant being able to have more control over the view of risk that goes to market and goes to reinsurers, and reinsurers being willing to underwrite that because we're helping them contain loss cost uncertainty, with effectively is a weather-driven modeled loss index. And what that means with respect to basis risk is that a lot of questions come up from the market, wanting to understand what exactly is the potential mismatch between something like a modeled loss index and my indemnity experience. The short answer to the question is that generally we find that our modeled loss index can track as close as 1% to indemnity losses as they accumulate to the year, and typically, around 10% delta plus or minus compared to indemnity loss. We like to take a step back when we're working with the market to understand basis risk broadly and also in the context of our modeled loss index product. And first is just talking about, okay, basis risk or mismatch relative to what? Just to help set the stage. Everything from claims adjuster behavior to exposure management, evolving terms and conditions, inflation, um, utilizing traditional catastrophe models, and having different numbers, different PMLs across those models. So there are a lot of places where uncertainty can arise. And when you talk about parametric risk transfer products, we also like to contextualize the different types of products that are out there for risk transfer. On one end of the spectrum, you'll have your indemnity recovery products. On the other end of the spectrum, you might have a pure event-based trigger, like measuring wind speed or measuring, how much the ground shakes in terms of an earthquake cover. But there are some other products that kind of fall somewhere in between those endpoints of that spectrum. Industry loss warranties are quite well known. You could argue they fall somewhere in the middle. And then our approach, it's effectively to create a cedent-specific modeled loss index that's trained on the look-back loss experience of the cedent, but also the look-forward terms and conditions and exposure footprint of the cedent. And so when we're characterizing our product in this qualitative way, we like to say that, of this spectrum, we're more on the end that's closer to indemnity because of this direct calibration to the cedent's experience. What Jake highlighted and what Jim highlighted as far as kind of the context in the market and the problem being solved, it led us to listen a lot. And the feedback that we got over and over again with respect to parametrics and basis risk is, can you make this product look and feel like an indemnity aggregate cover? And that was very much our guiding principle as we continued to pour resources into improving our modeling and index over time. And so where we sit today, we actually have a true ground up working layer solution that can maybe be hard to find in traditional form or quite expensive in traditional form. And so this allows that cedent to protect against either event-specific types of risks or aggregate level events across a risk period, and particularly targeting those risks in that retained layer. So if you have those blowout losses, you're typically seeing these carriers have traditional catastrophe cover sitting on top of this modeled loss index layer that can help address those 1 in 1,000 or more rare types of events. The last piece I'd like to highlight is just that, basis risk and calibrating this product, it is an ongoing process. An obsession of ours has become this notion of potential mismatch. And so what we've done is, as a part of our ongoing research and development, is even for those cedents who have sent us data and we built models and an index for them, but they did not purchase reinsurance, we send them regular reports every quarter to show them how their modeled loss is tracking. And then we get feedback from them on their indemnity losses. And so that's where we start to get a sense of those stats that I gave earlier of, how close or how far away might we be. And we see that typically over the course of a year across the space of an exposure footprint, we'll see those modeled losses tracking reasonably well. And one prospective cedent who's considering our product as an anecdotal case study, they're located in the Midwest. Their indemnity losses through August were about 74 million. And then the modeled loss total coming from our index was about 79 million. So that's about a 7% difference. And so that type of ongoing feedback is what we continue to pour into our ongoing research and development, and really taking those opportunities that we can to update the model every single year with the most recent loss experience, and ultimately continue to give the cedent that control over that view of risk that goes to market and gets priced.
Great. Matt, I know we've spoken about it a little bit before, but the other sort of misconception is that basis risk doesn't exist in indemnity products. So I don't know if you want to just touch on that side of things too.
Yeah, and that's kind of what I was highlighting at the outset was, the potential mismatches to loss experience and uncertainty, they can crop up anywhere. We've heard, for example, that some cedents can see there was a PML number of around, I think, a 1 in 50 SCS loss experience from one traditional catastrophe model that was sitting maybe around 50 million, and another that was around 80 or 85 million. And so it's, as a consumer of that and using those tools, the question becomes, okay, what do I do with that information? Do I just take the two and average them and use that, as guidance on, where to set attachments for different aspects of my program? Do I lean more heavily or weight more heavily one of those views or the other? And so it highlighted to us kind of how this uncertainty can pop up in different ways. And so where we find ourselves is having to be highly accountable for tracking these every year, updating our models every year, as opposed to, some more infrequent cadence of pouring the latest and greatest information of exposures and claims into our modeling. But yeah, these potential mismatches and uncertainty, they can arise even for traditional indemnity products and indemnity analyses.
Great. Thanks, Matt. Before I bring in Jim to also just talk a little bit more about that more broadly, Jake, from your perspective, was the basis risk discussion a big conversation?
Yeah, I think that's very fair. It was a conversation. I think, the reality of risk is we all, especially if you're in property casualty and rooftops, you gamble on the weather, right? That's why I don't buy Powerball tickets, because I haven't been very fruitful the past few years on the weather. But I think, your basis risk is present. It's never gonna disappear, right? And I think it goes back to, 100-plus-year-old mutuals, and some closer to 200 in many cases, especially out east in Eastern Midwest, is we've just had to figure some things out and through the years. And this is a great tool that you can piggyback on more traditional products. And it's not that far. I don't want to put it in a bucket of untraditional, because it's not. It's very similar. It's just a matter of getting the regulatory comfort and the internal comfort of your boardroom and your executives to say, okay, this is a great tool. So I think as an industry, we don't shy away from risk. That's what we do, no matter how we label it. But I think we all are just constantly viewing what could be a backstop in the worst case scenario that I feel like we've seen a lot of, in the past 5-6 years in this industry. And that's not going to change, right? I hate to break it to everybody. We've got to be prepared with that stuff, priced appropriately, deductibles appropriately, and great tools like this to have a backstop when the weather comes, because it sure as heck will, right?
And
Great.
I would like to
Thanks,
add
Jake.
that, that perspective, it exists on the reinsurer side of the transaction as well, is, having, our lead capacity providers who we work very closely with, that's how they look at risk. They say, I'm in the business of taking natural peril risk. Here's a product that is packaging, an aggregate exposure in a way that gives me that natural peril risk and effectively fixes that damage function and reduces the loss cost uncertainty from their risk-taking perspective. And so even when, recoveries start to flow from these reinsurers, they're asking us for, the quarterly reports and the analytics that support that, so they can make the case to their accounting teams and their leadership teams of why they're paying out on this new product. But they're also using those quarterly reports to make the case that they want to continue to scale with us and continue to grow the amount of capacity they bring to the table, because, again, to Jake's point, they know they're in the business of taking this risk. And once again, they are keeping us accountable and looking at loss outcomes and where they fell in the preseason pro forma distribution. And so we always have to be able to demonstrate that to both sides of the transaction and help everyone understand, how this product is tracking and why it's paying or why it's not.
Yeah, I mean,
Great.
think
Yeah,
when
go,
we
Jim.
look at it, I think it's creating a product that has long-term sustainability. When I look back at the traditional aggregates that had been in place for a number of years, and why did that marketplace kind of dry up? It could have been because it was inadequately priced, and some of the attachment points of those aggregate programs were attaching at a 70% attachment point. When the market started getting harder, I think the reinsurers, they looked at it and said, this is not sustainable because it's kind of a cash cow out there. It's being hit on an annual basis. And, in terms of putting a program together, it has to work for all parties. It just can't be one-sided. So, when we look at a product like this and we talk about basis risks, and we talk about positive basis risk, but we also see situations where we could have a negative basis risk from that standpoint. I think if you look at it in terms of a negative basis risk and maybe like a potential miss that could be out there, you have other reinsurance structures like your traditional property cat tower that would pick up the severity of a larger type cat, as opposed to parametric coverage is jumping in and being more of an event type cover, at least for this product, if we're looking at more of an aggregation type standpoint. One of the questions that I do get a lot, and obviously it's a concern, indemnity versus, parametrics is, again, what if the indemnity is much greater than the model losses? And, to Matt's point, they'll monitor the situation for each client, and then you'll be able to see through a document where there's positive basis risk, in terms of a quarter, and then also negative basis risk, in a quarter. So it does exist out there. And it's making sure that you take your entire reinsurance program and you put it together as a puzzle to make sure it works in a number of different ways for you.
Great. Have you got any other comments on that side of things before we move into, we do have a question from the audience as well, but are there any other comments around that space?
I think we move into the question.
All right. And if anyone does have any more questions, we do have a little bit of time to cover them, so please add them in. I think this one's going to be for you, Jim. Do you expect traditional 2026 reinsurance renewals to show stabilization or continued hardening for SCS layers?
No, I think we're showing some stabilization. I mean, I think the market is definitely getting softer. Reinsurers definitely want to be responsible. Each program needs to stand on its own 2 feet. And with all of our meetings with reinsurers, we're starting to see reinsurers talk about how the traditional aggregate market space could be coming back at 1/1 of this year, for these renewals. We are having discussions, with those reinsurers, but keep in mind, when we're talking about severe convection storms, and aggregate can cover you in terms of severe convection storms, and it's also going to cover you from individual losses like fire losses, etc. So if the main concern is around wind, hail, tornadic type activities, this is where a product like a parametrics cover could be something that could work a little better for you. I mean, if the concern is fire type losses, and that's what's driving your loss ratio, this is not the product. But if the concern is the severe convection, storms, this is something that you should definitely look to entertain. But again, the marketplace is softening. There could be other products that could exist out there, not only at 1/1, but into the future. And it's our job as a reinsurance intermediary or whoever everyone uses to go out and push the markets hard to see what solutions are available for them.
Okay, thanks, Jim. It looks like we don't have any more questions, so I think we'll close the webinar there. I'd really like to thank all the attendees for their time, and in particular the panelists for a really enlightening and interesting discussion. We'll carry on the conversation. If you want to by getting in touch with Demex or AcrisureRe, I guess in the first instance. Just put a couple of emails up there, and yeah, thanks again to Jake, Jim, and Matt.